Interested in trading stocks? Well, you don't need to restrict yourself to stocks within your own country. These days, you can buy and sell stocks from all over the world, including the biggest and arguably most important market of all, the United States. In this video, I'm going to cover everything you need to know to get started, including finding a broker, how to order your stocks, the kinds of fees you can expect, and how much money you need. First, why US stocks? Up until fairly recently, Australian investors have been mostly focused on Aussie stocks. That's because as little as a decade ago, it was pretty tough to buy shares from other countries. Not many brokers offered global stocks, and if they did, it was pretty expensive. Even today, most Australian stock portfolios would typically consist of the major banks, BHP, CSL, and maybe a few up-and-comers like Afterpay. The problem is, Australia's market is pretty small and it's not as fast growing as some others, especially compared to the United States. In fact, Finder Research has found that if you'd invested $500 in the ASX 200 index just after the 2008 market crash, well, as of May this year, you'd only have made $860. On the other hand, if you'd invested in Wall Street's NASDAQ index, which features the likes of Facebook, Amazon, Apple, Netflix, and Google, your portfolio would have grown to over $1,500. And when you're working with bigger numbers than just $500, that's a pretty big difference. The US stock market also offers a greater diversity of companies than we have here in Australia. The New York Stock Exchange and the NASDAQ are the two largest stock exchanges in the world. Australia's main stock market, the Australian Securities Exchange, is just a fraction of its size and is largely dominated by financial and mining companies. So a portfolio of top Australian stocks isn't going to be as diversified as a portfolio of top US stocks. Now, on to the steps. Step number 1, find a stockbroker. To buy and sell US shares, you'll need to sign up with a stockbroker that gives you access to the US market. Now, you could go with a traditional full-service broker like Morgan Stanley, but that's very expensive. If you're just starting out and you don't have a spare $250,000 cash, the much cheaper option is to use an online share trading platform. There are plenty of trading platforms out there, but not all of them offer US stocks. And some of them do, but they charge exorbitant prices. On Finder, we have a handy trading comparison table to help you compare, and the link is in the description below. So what are the costs? When you're picking your online broker, one of the most important costs to look at is the brokerage fee, also called the commission fee. This is the fee charged by your broker every time you buy or sell stocks. Brokerage fees for US stocks are very different depending on the platform you choose, ranging from as high as $60 a trade to $0 a trade. That's right, some brokers charge nothing at all to make trades. On a side note, we don't yet have a zero brokerage option for Australian stocks. So far, it's US stocks only. In any case, just because you don't pay a brokerage fee for US stocks, it doesn't mean it's free. Nothing is free in investing, so read the fine print. The other big fee to be aware of is the currency conversion fee. This is the fee charged by your broker to convert money from AUD to USD, because you can't buy US stocks in Australian dollars. So your broker will typically charge a fee to convert your money whenever you make a trade or when you top up your account. So if you're using a zero brokerage trading account, the conversion fee is probably going to be the most important cost. The other fees you should take note of are the account fees, custody fees, the inactivity fee, which is the fee you're charged if you don't make enough trades in a month. It also pays to be aware that some brokers, like CommSec, don't charge an inactivity fee on Australian trading, but they do charge a fee on global trading accounts. Also check how many country markets the broker has access to, how easy the platform is to use, is it fast and simple and user-friendly, and can you access it on your desktop or is it only on your phone? Step 2. Open and fund your account. Once you've worked out which broker you want to go with, it's time to sign up. You need to be over 18, plus you'll need your ID and tax file number. This application process can take as little as a few minutes to a few weeks, depending on the broker. After you've signed up, you'll need to top up your account. This is usually a bank transfer, but it could also be a credit card transfer, PayPal, or debit card, and the broker will usually open up a bank account for you under your name, so it pays to be aware of that. Picking your stocks. Picking your stocks is the fun part, but it's also the most challenging. Who would have guessed that Tesla shares would be 800% higher than they were a year ago, or that Zoom would go from being a $60 stock last year to a $200 stock in a matter of months? And look, if anyone actually has some inside knowledge that a stock is going to be the next big thing, I can guarantee you they're keeping it to themselves. But there are a few tips that can make it easier. First up, pick a company you know. Do you use its products? Are you a fan? If so, you'll have a better idea of if it's doing well or if it's failing customers. Follow broker ratings. You can follow the ratings and price targets set by investment firms or analysts. Pick a company you believe in. Do you think it's making all the right moves? Is it ethical? And even if you're not into ethical investing, trends show that a lot of other people are. Debt levels. Make sure the company debt is under control. If it's not, it's going to have trouble growing, and worst case scenario, it may even go under. Expansion plans. Is the company moving into new markets? Does it pay dividends? Dividends are a percentage of company profits, which some choose to pay out to its shareholders. Dividends don't tend to be as high on average in the US as what you'd find in Australia, but it's still a pretty important consideration. Finally, valuation. Is the stock overpriced or underpriced? Check out the link in the description below for tips on how to value a stock. Step 4. Order the stocks. Stocks are priced anywhere from less than a cent to thousands of dollars. A higher priced stock doesn't necessarily mean that it has higher value. For example, around mid-August 2020, Tesla shares had a price of around $1,500. At the end of August, they split their stock by 5. This is called a stock split, which means that Tesla shares will be priced at around $300 each. This doesn't change the value of your Tesla shareholdings, it just means you can buy more stock for a lower price. For Australian stocks, there's a minimum $500 investment for every new ASX company you invest in. But that's not the case with US shares. In fact, depending on the broker you choose, you could invest as little as a few cents into a US stock, if that's something you're interested in doing. And some US trading apps like eToro, Stake, or Interactive Brokers allow you to trade in fractions. This is called fractional investing. This allows you to buy part of a share rather than whole shares. So instead of paying $1,500 for one Google stock, you could invest in 1/10 of a share for $15. This feature is only available to US stocks. We don't yet have this option for Australian stocks. The process to actually buy your stocks is different on every platform, but generally you'll have at least a couple of order options. Your most basic order is called a market order, which is where you buy at the latest available price. So say I'm wanting to invest $1,000 in Apple, my trade will go through at whatever the stock is priced at the time the trade goes through. And then you have your conditional orders, which is where you can select a specific buy price or a buy price range. For example, say I want to invest in Apple, but I think its share price is going to fall in the near future, I can set a limit order to buy once Apple stock falls to a lower price. And then after you enter the number of stocks you'd like to buy or the amount you'd like to invest, preview and confirm your purchase. And you can do the same process in reverse to sell. If you want to invest in the US market but aren't too keen on stock picking, you can also invest in a US-themed exchange-traded fund. An ETF is an investment fund that holds hundreds or thousands of company shares. So instead of buying stocks in one company, you can invest in a whole portfolio of stocks. The ASX has dozens of ETFs that track US companies, including NASDAQ ETFs, ethical US stock ETFs, US property ETFs, you name it. To check out some of the best performing ETFs in Australia, you can find a link in the description. Your other option is to invest using a robo-advisor or micro-investment app such as Raise or Spaceship. Robo-advisors invest your money into portfolios of ETFs or portfolios of stocks, and many of them hold US stocks. Next steps. You'll want to keep an eye on the performance of your stocks. Unless you're an active trader, you should try not to check on your stocks too much, say once a week or once a month at most. Otherwise you'll get sucked into the drama of the market and you'll probably start making some pretty poor decisions. You'll need to pay tax on profits, including dividends. The US side of this is usually dealt with by your broker, so check with them, but you should only be taxed once, usually on the Australian side. The same tax rules that apply to Australian stocks also apply to US stocks. Around tax time, you should get a financial summary from your broker with your taxable income. So what are the pros and cons of buying US shares? Let's start with the pros. You can access different investment opportunities, such as the FANG stocks. With fractional investing and zero broker fees, it can also be more affordable than investing in Australian shares, especially if you're just starting out. By investing in overseas markets, you're diversifying your portfolio, and you get to invest in more companies you know and own. Now for the cons. Depending on your broker, brokerage fees can be higher. Trading in US stocks means you're vulnerable to AUD to USD currency fluctuations. Because you're dealing with US markets, most of the trading happens after you go to bed, so it can be tricky to keep an eye on prices and events happening overnight. You'll have to pay a fee to exchange your Australian dollars into US dollars, and this process can add time to your trades. Well, that's it from me. For more information about anything I spoke about and to get started investing, check out the links in the description below. Plus, for more investing videos, subscribe to our channel.